Hi guys, I welcome you to this very interesting topic of capital budgeting. Capital budgeting is mainly concerned with decision making on where to make the investment. And capital budgeting is the most important topic within the context of financial management. So I would like you to go through these slides. You can take notes. You can copy this presentation. So good luck on capital budgeting. Let's now consider some subjective criteria for making the investment. The first point I got here is availability of skilled manpower. So naturally, there are some investments in industry that require specialized skills of manpower. So that can become a very important criteria for deciding where to make the investment. The second point I got there is nearness to the port. So naturally, if the business is involved in exports, so naturally it's advisable to make the location near to the seaport so that goods can be exported conveniently. The third point I got there is approach to markets. So it's always advisable to locate the business near to the markets so that you economize on transportation cost. And the next point is development zone and tax holiday. So there are development zones that are planned by government where incentives are given to investors in the shape of tax holiday. So investors always try to take advantage of these incentives and locate their business in development zones. And the last point I got there is cheap power. So as you know that industry needs power, and if power is cheap, then it is always advantageous to locate the business in that particular area where cheap power is available. Okay, now let's consider the various techniques that are available to do the evaluation of various options that are available before a final decision is made for investment. The techniques are well known, and they are: number one, payback period; number two, accounting rate of return; number three, net present value; and number four, internal rate of return. And there's a final technique that is called profitability index. So I'll discuss these various techniques one by one in the next slide. So let's now consider the first method, and that is payback period. What is meant by payback period is that in what time frame the project will return the initial investment. Normally, this is considered in relation to the cash flows that are the residue after all the costs have been met. So we consider the cash flows and we see in how many years the project will return the investment that was made in the project. Now let us take an example. A company is interested in making an investment of $250,000, and it has estimated the cash flows over a given period of time as shown in the next slide. So now you can see the initial investment of $250,000 in the year 2003, and then we got the cash flows coming in the year 2004, 70,000, 2005, 80,000, 2006, 80,000, 2007, 80,000, and 2008, 75,000. So these are the residue after meeting all costs. We call it cash flow. So these are the cash flows over a period of 5 years. And how we work out the payback period is shown in the next slide. So as you can see, the first year cash flow is 70,000, the second year cash flow is 80,000, the third year cash flow is 80,000, and the fourth year cash flow 20,000, and that adds up to 250,000. If you recall, the investment made in the project was 250,000, and this investment is recovered in 4 years' time. So the fourth year cash flow 20,000 is less than a year, so you can say that it's 3 years and maybe 4 months time the project will return the initial investment. This is how we figure out the payback period. So you can see that the payback period is 3 years and 3 months. So what's the benefit of payback period? The payback period tells us that the time frame in which the investment will be returned in the shape of cash flows. So investors prefer shorter time frame to get the initial investment back. So if an investor is considering 2 projects, then the project that returns the initial investment earlier has better chance of selection. So the other method of evaluating investment opportunities is called accounting rate of return. Now what happens in this method is that investors consider the cost of capital. Suppose they are taking a loan to finance the purchase of equipment. So they consider the rate of interest they have to pay on the loan, and then what's the expected return from the investment. So they match the percentage return on the investment with the interest rate they pay on the loan that they take to finance the purchase of the equipment. And naturally, if the investment returns rate is higher than the cost, so they will go for that investment. So let's take an example. Again here, a machine that costs $500,000 and the residual value is 75,000, and let's continue this example in the next slide. So the estimation is that the additional increase in income will be $65,000 per annum. So now we have to calculate the average investment, and as shown here in the slide, that the initial investment was $500,000 and the residual value was estimated at $75,000. That adds up to $575,000 divided by 2, so we get an average investment $287,500. So now the calculation is we take the average annual net income after tax and we divide that by the average investment. So $65,000 is the average annual net income after tax divided by the average investment $287,500. So we get the return that is 22.6%. And this return can be compared with alternative options available to the company and also with the rate of interest that the company has to pay on the money borrowed to finance the purchase. Well, now we'll consider a very important method of evaluating capital budgeting, and that is internal rate of return. It's abbreviated as IRR. In this method, we calculate the return in percentage from the project. And there is a formula to compute the percentage rate of return from the project. Once the percentage rate is computed, it is then compared with the cost of capital. So naturally, the rate of return from the project has to be higher than the cost of capital. So if the project is launched by borrowing from bank, and if the bank rate is 18%, the project return must be more than 18%, and then only it can be selected for investment. So let's consider the mechanism for computing the percentage rate of return in the next slide. So the method to compute the percentage return from the project, we have to use two rates for discounting the cash flows. These two rates should be far apart so that using one rate should give a positive NPV and the other rate should give the negative NPV. So we have to be careful in selection of the percentage rate for discounting the cash flows from the project. You have to end up with a positive net present value and one negative net present value. So that is important and you have to be careful there. So let's proceed in the next slide. So the best thing is to take an example to illustrate the method of computing IRR. And here we got a project where the investment is $100,000 and the return from the project are $28,000 for each of the first 5 years. Now we've got two rates here, 10% and 14%. So they are fairly apart so that one rate will give us a positive NPV and the other rate will give us a negative NPV. Now we got this 10% rate for discounting the cash flows, And you can see the tabulation here. We got the years from the year 0 to year 5. We got the investment, that is $100,000, and we got the cash flows, that is 28,000 from year 1 till year 5. And then we got the 10% discounting factors. These are available in the finance textbooks, but you can also calculate them using your calculator. So we multiply the cash flow with these factors to get the discounted cash flow. So we have the calculations, we have the answers in front of you, and then we figure out the net present value, which is abbreviated as NPV. So the NPV here is $6,120, and it is a positive NPV. And now we'll use the other rate, that is 14%, to see what NPV we get over there. Now we got the another tabulation where we discounted the cash flows using the rate 14%. So we got the factors at 14%, and we multiply the cash flow with the factor to get the present values, and then we get the net present value, which is $3,904, and it's a negative NPV. There's a formula in front of you, and you have to memorize this formula, because in the examinations you may have to use this formula in your calculations for IRR. And as you can see that we got X, which is the rate giving positive NPV. So in this case, 10% was the rate that was giving us positive NPV. So we have to put 10 over here in place of X. And then PQ is the difference between two rates. So we have used two rates, 14% and 10. And the difference between the two rates is 4. So we'll place 4 over here in place of PQ, and then we multiply with the positive NPV. And the positive NPV we calculated using the 10% rate. So we pick up the net present value and we multiply that with the difference between the two rates, that is 4. And then we divide the answer by the total of positive and negative NPV. So we add the positive NPV and the negative NPV, and then divide the answer of PQ times AC by AD, and that will give us the IRR rate. So you will see that in the next slide. This presentation gives you the calculations using the IRR formula, and you can see the IRR rate is 12.04. So this is the rate that we wanted to compute in this project, where $100,000 were invested, and we had 28,000 cash flow over a period of 5 years. We have discussed several methods of evaluating investment opportunities, and profitability index is another method to evaluate various projects and to come to an answer as to which one is the most feasible investment opportunity. You got the formula there. It's very simple, nice and easy formula. We divide the present value by the investment, and that gives us the ranking of various opportunities or projects, and then we can decide which one is most feasible investment opportunity. So now let's take an example to illustrate how the IRR is computed. There's an investment that requires $60,000, and 4 projects are being considered, and the projects are divisible. So let's proceed to the next slide to see how the IRR calculations are conducted. So first of all, we'll consider the ranking based on net present value, and the tabulation here shows that project D has the highest NPV, so it's ranked number 1, and then project C is ranked number 2, and project A is ranked number 3, and project B is ranked number 4. And now we follow the profitability index formula, and we divide the present value by the investment to arrive at the PI ranking. So now you can see that project A is ranked number 1, project D is ranked number 2, project C is ranked number 3, and project B is ranked number 4. So this tabulation compares the 2 rankings. Number 1, ranking based on net present value, and ranking based on profitability index. And remember that to compute profitability index, we take into consideration the investment. So we compare the investment and the present value to arrive at the ranking. Now consider that if we adopted the NPV basis, then our selection of project will be project D as the first selection, and then project C, which is a divisible project, so we only invest 20,000 in project C, which has a NPV of $1,487, and then we take the total. So its investment is $60,000 and the NPV is $5,288. Now if we look at the profitability index basis of selecting project, then we got project A with investment $10,000 and NPV $1,240, and then we take project D, which has investment of $40,000 and the NPV $3,801, and the balance goes to project C, which is only $10,000 with the NPV of $743, and the total is investment $60,000 and the total NPV $5,784. Now you can see that by following the profitability index method, we now have improved our NPV by $496. So you can see the point there that profitability index method appears to be a better method when compared to the NPV based methods of evaluating various projects for investment purposes. So guys, these are the several methods that are generally used to evaluate investment opportunities. You have to remember that when investments are to be made in projects or in equipment, machinery, then there are various options available. Like if you want to purchase an expensive plant for the factory, then you may have the options available, like whether to purchase from Korea or from Japan or from UK or Germany. So you get the information and then you use these methods to evaluate all these 4 or 5 uh, options and arrive at the best answer as to which equipment or which plant is the most feasible investment opportunity. Similarly, if there are several projects that you are considering, then you can evaluate each project using all these methods that were discussed in this presentation, and then you can arrive as the most feasible project where you can safely make the investment. So I hope you have understood the methods. I wish you good luck and try your hand, do some questions on capital budgeting to gain the confidence that you can come to a solution using all these methods. And from examination point of view, you have to be very careful in applying the formulas, the methods, the approach of capital budgeting. So I wish you good luck and see you in some other presentation on the subject of finance. Bye for now. So I got here a question for you to attempt. Uh, Try your hand and see what you achieve. And this is the answer to the question. So you can note this down. Try your hand, see if you reach to these figures by yourself. Good luck.